Hi, welcome to Numerix Video Blog. I'm your host, Jim Jockel. It is a casual summer Friday here in July, and we're going to sit down and have a nice little casual conversation with our Quant of the Year, Alexander Antonov. Alexander, welcome.
Thank you, Jim.
So you were just at Quant Congress this week here in New York City, and one of the trends that I'm starting to see on the conference circuit right now is what is the future of quantitative finance? And arguably, there's been a shift in terms of, or merger, if you will, in terms of front office and risk management. What are some of the comments and concerns that are going on in these conversations?
Yeah, as you said, we have a quite big merge between the front office and the back offices, the middle offices, where we calculate the risk metrics like XVA for different aspects of the risk. So we don't need only to calculate the price, but also all these valuation adjustments. Some of them are for the banks, some for the regulators, organisms, and so on. So we have more and more new of them. So this calculation becomes really bespoke. For example, if you have initial margin, we should come up with the initial margin valuation adjustment, with changes your prices in the future. A lot of regulatory new things coming of FRTB and other Basel III and so on. So a lot of things are done around the portfolio, big portfolios. And so this changes the nature of quantitative finance.
So arguably some of the Basel FRTB calculations themselves are pretty straightforward. They're prescriptive, but yet there's still levels of complexity that cannot be dismissed within these calculations. Is that accurate?
That's right. That's absolutely right. So if you know how to calculate the sensitivities of our products, our portfolios, we can come up with the quantities required by FRTB or Basels. However, if we want to calculate the valuation adjustment in the future, this will require some more complexity for our modeling side. So that's the difference, for the current calculation required by the regulators and the future, which banks may be interested to see how much money they will spend to raise this capital, the required capital by these, FRTB and Basel III agreements.
Now, one of the other changes that we're continuing to see is really, in terms of quantitative finance, is, obviously there's some changes and evolutions still within the pricing model space, but more technology advancements in terms of performance. And AAD seems to be gracing the pages of Risk Magazine.
That's right, exactly right. Yeah. So as far as we need more and more information about the current and future prices, including the sensitivities, we need to calculate them rapidly and almost at the same time as the pricing, maybe less frequently, not like a real time, but still we need them quite frequently. So that is why we need the speed of calculation. And the speed of calculation can be either with the new hardware things like GPU or new software things like AD, which is a joint differentiation, which permits us to get the derivative of whatever price or XVA rapidly.
And that's also coming on the back work of some of the work you've done in terms of American Monte Carlo as well, isn't that correct?
This is true. Yeah. This American Monte Carlo methods can help us to calculate these sensitivities and also the XVA rapidly. So this is one of the mechanisms which permits us to do these things properly, almost at the real time.
But I think one of the common misperceptions in the market, with whether it be GPUs or American Monte Carlo or AAD, is that a one-size-fits-all approach is not necessarily the most efficient and practical approach in terms of kind of meeting that scalability and performance requirements.
This is true. All of these methods can be somehow bespoke, bespokely used for different levels and of instruments of the portfolios and different levels of the XVAs. So one should of course use these methods properly. American Monte Carlo will underlie all the complicated instruments involved in the XVA, but for example for less complicated instruments we can get analytical means. We can also sometimes we know just analytical price as function of the parameters. So we don't use an 80. So the wisdom is, of course, to apply the things which we needed to for concrete tasks.
Also, just kind of looking at the trades, there's been a lot of notable movements in the market of different quant teams, other areas kind of changing their asset class focus, and different banks ramping up their focus, but also starting to see a little bit of a migration of quantitative resources to the buy side even more. Any insights and thoughts on kind of what's going on in terms of the shift in priorities of institutions now as it relates to their quantitative teams?
I would say that now quants not necessarily write their formulas with a pen and a sheet of paper, but they should also be hands-on for the programming, hands-on for the technology like GPU and other hardware accelerators. So the quants should understand also the details, the fine details of FRTB and Basel, the agreements. So a lot of extra information are needed for quant work. Having said that, they will probably need less knowledge in mathematics, but more. It's always a compensation. If a quant goes more in the technology and to the details of the capital and other agreements, then he doesn't have the time and maybe even the desire or whatever to write try the things with a pen and paper. The models are less complicated, but the instruments and the whole aggregation of the results are more complicated.
So I think arguably in every career path and discipline at this point, we're all challenged to know more about different things, and it seems like the same for the quant world at this point.
For sure, yeah.
Well, Alexander, I want to thank you so much for your insights, and I hope you'll get some rest this summer after your negative rate world tour, and I'm sure we'll look forward to some new interesting papers from you in the fall.
Thank you very much, Jim. Thank you.
Thank you. That'll conclude today's video blog, and of course we want to talk about the things that you want to talk about, so follow us on LinkedIn and on Twitter at NX Analytics. Thanks, Alexander.
Thank you, Jim. Thank you.